Okay, thank you, ladies and gentlemen. Welcome to the first SDI track. This is our finance track. And I'd like to introduce you to Youngjin Choi. He's head of impact investing at Fineo. And he'll be talking us through what will it take to win the hashtag race to zero. Very consistent with our sustainability theme, our roadmap theme, sustainable by 2030. Before I hand over to Youngjin, I'll just let the audience know you can please throughout post your questions and post questions in the chat and in the questions box. And at the end of I think it's about a 25-minute presentation, I will, as the moderator, I will ask those questions to Youngjin and create that dialogue with Youngjin. And they'll also, obviously, all of this will be available to download later on the Sustainable Places website. Youngjin will also be sent his own version, so if you want to contact him directly, you should be able to see in front of you a handouts bar, and from there you can download some contents. Most of what's in there is generic to Sustainable Places 2020 or actually relevant to the next presentation, which is Alex from NIBC. So without waiting too much longer, I'll hand over to Youngjin for hopefully a fantastic presentation.
Thank you very much, Mohan. Yeah, and also, yeah, I'm glad that I can be here. I will give you a brief overview of what I want to cover over the next 20-25 minutes. So there are a couple of aspects I would like to touch on. So the urgency of our time to create and reinforce the urgency awareness that I think is lacking in our society to some degree. Then describe the race of our lives as Jeremy Grantham coined it. It's the race to net zero, and then what it takes to win this race, right? And what role the built environment can play, climate impact investing, and there are other success factors that are also important to keep in mind. So the urgency of our time, I'm not sure sometimes I really wonder how many people realize that as a civilization, we are currently walking a thin line, and there is really a substantial increase in the risks that multiple types of risk, as you will see, that we are currently allowing to happen or not mitigating properly. So as of recently, just right now, if you look at the pledges and how sufficient they are to from different countries, how sufficient they are to keep us in line with the Paris Agreement goals, there's only Gabon and Morocco, I think, who are coming close, and as you can see, most countries are either critically insufficient or highly insufficient or insufficient. So even the pledge, to reach net zero by 2050 for a developed country, for a developed economy, is actually too late if we look at it, from a climate impact point of view, and with the desire to really reach a stabilization of less than 2 degrees centigrade by 2100. So if just to give an idea of the volume of human carbon emissions, currently, if you imagine a forest area that would cover the whole African continent, and it would burn for every day, throughout the whole year, then even you would come close to the human carbon emissions. Actually, it's even an area larger than that. And there's many of you have seen the warming stripes that help us visualize. And what I like about this overview is that you see 4 different data sources which roughly show a similar pattern, over the past century and a half. And so what is also important to keep in mind is that the temperature increase is not similar across the globe, and actually it's disproportionately high in northern latitudes, which is why, for example, the Arctic, as you can, if you have noticed in the news, is really showing abnormal behavior. But yeah, so in northern latitudes and southern too, to some degree, this is something that will also impact the jet streams, which are becoming more unstable and volatile over time. And if you look at the current forecasts based on different shared socioeconomic pathways, so these are the models that the IPCC has more recently developed as an upgrade to the models that we used beforehand. So the shared socioeconomic pathways describe different possible futures in a world without a substantial, climate policy change. So you can say different business as usual scenarios, which are more optimistic or more pessimistic. I think SSP3, which is assuming a world with increasing, national tendencies and instability in terms of geopolitical collaboration and so on. It looks like it could be the most likely one. We will see that, of course, over the past years, the increase in radical nationalism has been very noticeable. And overall, the range is between 3 to 5 degrees C by 2100 as a business as usual forecast. And this has profound implications. So at 3 to 4 degrees C future would cause migrations over time. I think also many of you who have looked into the impacts of the global warming and planetary heating, we are aware of this, leads to massive migration streams away from the equatorial areas. In addition to this, you also have, of course, sea level rise that is affecting the coastal areas, which are also densely populated. So here you see an estimate of 6 meter rise, which approximates the ice mass of Greenland, while the Antarctic ice sheet would add another 60 meters. But these are, just to be clear, this is a long-term process which takes centuries to unfold. So within this century, we will see not 6 meters, but something in between 1 and 6 meters is quite likely. And what is, I think, one of the most important and dangerous implications of impacts of increasing temperatures throughout the globe are the geopolitical tensions that will be increased, especially between nuclear powers over critical resources. And I think most of the economic damage estimates and the models that try to anticipate the cost to human society do not cover this or address this risk very, very well, of course, because it's difficult to model. It's a consequence of human societies being put under stress, but the likelihood is certainly increasing. So it's for this reason that the doomsday clock has been very recently put to 100 seconds to midnight, which has been as close to 12 o'clock as it has ever been, as you see here. And over the past couple of years, the doomsday clock was, while it was more relaxed a few decades ago, has moved ever closer. So this is a risk that really demands our attention, and it's also the reason why, it's exacerbated by the fact that over recent years, misinformation, anti-scientific sentiment, disagreement about what's actually the case, what's factual and not, plus a rise of populism and radical nationalism in Europe and in other countries across the world, are crippling democracies to take decisive action. So it's just coming at the wrong time in history, if you will. And in addition to this, we also face the risk of an economic crisis, right? So here you see the spread between 3-month and 10-year treasuries, which in the past were actually a relatively accurate indicator of recessions. So if you look at this, it all seems to be adding up to a perfect storm at the horizon. And one of the questions that, of course, comes to mind is whether this could be the fate of human civilization in the 21st century. Are we sleepwalking into a period of substantial decline and crisis? And so if you take a step back, if you wonder what has happened, I think one explanation or one way to put it is that our technological power has increased disproportionately over our wisdom, to manage this power properly. So the consequences of our actions and inactions stretch across centuries, while our foresight and wisdom is relatively short term. It's similar to a road ahead that we drive at night with a lot of curves, while our ability to look forward is relatively limited, but we are driving this road nevertheless with increasing speed. And one quote that I like in this regard is from John Davis, who said, "We are clever enough to create problems that we aren't wise enough to avoid." So Noam Chomsky, in his assessment, he states that we are currently at perhaps the most dangerous moment in human history, considering the climate crisis, nuclear war, and authoritarianism. And while there's currently a debate ongoing in the effective altruism community whether we are actually living through a hinge of history, meaning that it could be the most influential time ever, I think the climate science is relatively clear on that we are living through a hinge of history. And so in the hands of the early 21st century generation, which is us right now, I think there are really two very different possible futures that we determine, either in the very long term, 21st century, 22nd century and beyond, we see human civilization decline, or we maintain a chance for human civilization to expand, right? And so the 22nd century isn't even that far away, because for young parents today, their great grandchildren will likely be born in this 22nd century. And so I think the secret to great societies, or if you look in the past, and this is a quote that I also like, a Greek proverb. Great societies have become great because they learn to care for the living conditions of their far descendants. Society grows great when old men plant trees, knowing that they will never sit in their shade. So, the hinge of history could be also, described like this, these tracks where I think we have still a window of opportunity to reach net zero by 2050 in order to ensure or, maintain a chance for human civilization to expand. If we miss that window, we will see it will be very difficult, to still get back to that pathway. So, and meeting that, or what does this window of opportunity look like the rest of our lives? We have to reduce, as I think many of you know too, global emissions to net zero by 2050, meaning that over the next decades, so we have 10 years to 2030, 10 years to 2040, in 10 years to 2050, we will have to halve human emissions. And it will require a Herculean effort, as as it is said here. And the challenge is also that this chart is from 2016. It assumed that we had already taken the quick wins, but we haven't done so yet, really. So we are just starting now, hopefully, if we do. So the challenge has not become easier over time since then. And also to keep in mind, even if we manage to reach net zero, if you want to stay below 1.5 degrees C by 2100, we have to also find a way to go into, to generate negative emissions or to absorb substantial amounts of CO2 out of the atmosphere. Otherwise, we will perhaps still have a chance to stay below 2 degrees C with substantial risks. So what does it mean to reach net zero by 2050? It means that we have to phase out coal by 2030, oil by 2040, natural gas by 2050. And so in the end, it has to be, or will need to look like a zero fossil fuel energy mix, mostly with different types of renewables. Geothermal and water, hydropower can provide a relatively stable supply. And it also means that the use of fossil fuels has to stop by 2050, really. So if there's a fossil fuel company that pledges net zero operating emissions by 2050, this is only covering operating emissions and not the extraction, the sale of fossil fuels per se. right? So they basically pledged to stay in business until 2050 and beyond, which is quite a challenge then. And if you look at the potential that wind has, it could supply worldwide electricity consumption over 40 times, right? And also prices have decreased, and capacity has increased exponentially. Same with solar. You know, it's a huge potential, and there's enough energy that's coming for free. And also here, the story is that prices have declined radically and surprisingly for most people. And of course, capacity. Oh, here you see the price development for solar cell modules. And the installations have also increased substantially, which is all giving reason for hope. And you can argue that finally markets are on our side, right? So, you know, even just very recently, we reached another inflection point because it's even cheaper to build new solar power supply than to operate coal plants. And over time, you will also see that gas will, you know, see a similar fate as coal. So, you know, you can argue that we are moving into an electric age, into a digital age, where for the next 30 years, in order to reach net zero, you will have to electrify everything, which will also mean that we can use the potential of, you know, digital technology to a much greater extent than is currently the case. And for example, if you're wondering about baseload, you know, here's an example of how a highly electrified economy could rely on a relatively low level. In this case, it's nuclear for the US, but it could also be a mix of geothermal, hydro, and others. And especially if you expand and flex, you know, make the power grid more flexible across a large geography, the you know, potential to rely on just solar and wind is also sufficient, actually. And here the idea is that you have, of course, an overcapacity that you can then utilize to generate green hydrogen. Right, so it's not wasted. And but you know, if you look at the growth of renewables, which is impressive, of course, the magnitude of the challenge is, you know, also you know, gigantic, if you will. And this is a forecast assuming a significant renewables growth that still, you know, leaves even more than half of final, you know, energy production by 2050 to fossil fuels, which then, you know, in this case, of course, the energy mix isn't clean enough to allow for electrification to, you know, have a substantial climate impact and reduce emissions sufficiently, right? So this is the challenge, that we have to get renewables to, you know, 80, 90, closer to 100% by 2050 than might be currently the case. And as long as we continue with fossil fuel use, you know, emissions are set to rise, right? So this is also a given. And on the other hand, if you look at the recent development in European countries, you see that coal use and other fossil fuel use is still relatively, you know, sticky. Denmark, I think, is a nice example for visible reduction and you know, expansion of renewable energy. While Germany, Poland, Czech Republic are relatively, you know, difficult to, or have a hard time to reduce their coal dependency. And in addition to this, you know, there's also a strong gas lobby that is working on, you know, committing Europe to gas infrastructure, new pipeline projects, which basically will make it very difficult to reach net zero before 2050 or even beyond. And so, you know, this is also an important development, that we make sure that you know, we don't fall into this gas trap and expand renewables as much as we can. So what does it take to win the race to zero? If we had started earlier, we would have much more time, about 30 years for each of those 50% cuts. And now 2020, as you saw, we have about 10 years for each 50% cut. If we start even a decade later, it will be very, very difficult to reach net zero in time. And so because we have basically squandered the past 20 to 30 years, our the market adoption of climate solutions is still at its infancy or relatively emergent, as you can see here, right? Very early in the adoption stage. So over the past 10 years, the annual volume of renewable energy investments has stagnated, while it should have increased, maybe to more than even double. So we have a funding gap of $300 billion US. And if we were really to reach net zero by 2050 or get close to it, here you see two comparisons. One is the business as usual scenario, where $25 trillion US cumulatively spent on, electrification and clean energy, in contrast to $50 billion US spent on electrification and clean energy. So, I'm jumping over this. One way to look at this is that we can accelerate the adoption of clean energy through subsidies, carbon tax, but it's still going to be relatively slow. And the only way to speed this up is, this is based on a study from Rewiring America, the production ramp up and then a mandated replacement of products that reach the end of life through sustainable products. And so here's an overview how we can still maintain or stay within this 1.5 to 2 degrees C window by using a mandated replacement strategy. In addition to a carbon tax, I would say carbon tax is still helpful to accelerate, but it's perhaps not sufficient anymore. So this is a great quote by Saul Griffiths, who wrote the study. If businesses in the market, they can help, but when they arm wrestle with Mother Nature, they will always lose. Or Mother Nature will always win against the invisible hand. And one way to look at this is a metaphor of an object that is sliding down a scale, where current market and technology forces are, changing the slope, making it easier for the object to gain in speed, and carbon pricing is going to help in addition to this. But to really make sure that we reach net zero in time, we will need an additional push from behind. This is what I mean by accelerating the race to zero. Now, and I know I'm running short on time because it's going really quickly. So what I will only do now is focus on the built environment and a little bit on perhaps climate impact investing before I conclude. So as you know, or as many of you have seen, if you look at the total energy consumption, including agriculture, the global greenhouse gas emissions volume, buildings account for roughly 20%, including steel and cement. Cement is here 3%, and notably even has a higher share than aviation. So one way to, of course, utilize the built environment as a driver to net zero is to electrify buildings through heat pumps, electric ovens, smart glass, and so on. And as important enabler is going to be clean electricity supply, flexible power grids, and the right policies and financial incentives in place. So this is a given, and we can reduce the energy consumption volume even with the full electrification by making sure that on the one hand reducing demand, saving energy, saving electricity consumption, but also through technological improvements. But I think the big potential lies in building materials, and this is what I would like to point out here. If you look at cement and iron and steel, and roughly half of steel, the world's steel production is utilized in building and construction. So these are two very, very difficult to eliminate sources of CO2 emissions, and cement especially, because half of the CO2 emissions from cement are coming from a chemical process. And if you look at the relation between embodied carbon and operational carbon emissions for new buildings built between 2020 and 2050, embodied carbon will account for almost half of this. So there's a big idea promoted by Professor Schellenhuber to utilize timber, engineered timber, and substitute cement in order to replenish the terrestrial carbon storage, because you basically turn buildings into long-term storage pools, facilities for embodied carbon, right? And this is just a view of how over the past, before the beginning of this industrialization, atmospheric carbon was put into the earth, is being extracted and put back into the atmosphere, and we can stabilize this trend. And even, as you can see here, we can turn the building and construction material sector into a huge carbon sink if we manage to replace enough, cement through engineered timber, which from its properties has many advantages to offer, and is very suitable for 4 to 12-story buildings. So this projection is based on an assumption that 4 to 12-story mid-rise buildings will rely increasingly on timber versus cement. So the challenge of our time is perhaps, how can we accelerate the market adoption of engineered timber? And there are some examples for larger buildings and constructions relying on this new or relatively new technology. Okay, so just to conclude, the race to zero is on. Fossil fuels are starting to lose, and I'm just jumping over this here to this part where I think which is important. Climate impact investing can be defined as a capital allocation that contributes to a measurable reduction of annual greenhouse gas emissions. So, and this focus on the outcome in the physical world is also what distinguishes it from, for example, ESG investing, which is more about making sure that you have looked into all ESG criteria before you're making an investment, but they're not really very closely causally linked to real world outcomes. And if you build a portfolio of climate impact assets, you can first of all make sure that you divest, that you clean up your portfolio, that you focus your portfolio on aligned assets that are compatible or are going to become compatible with a less than 2 degrees C future. Or you can also focus on directly contributing or indirectly contributing solutions. Indirect contribution is, of course, renewable energy, for example, and electrification. Indirectly is everything else you need to enable this transition, like flexible power grids or energy storage, for example. If you look at different types of climate impact, we can distinguish between, of course, the negative ones and the positive ones, but also within the positive ones, we can see there's symbolic impact, which is just signaling. Although the real-world impact on emissions might be very limited or marginal, there's a broad, positive climate impact by supporting large-scale renewable energy projects at market rates, for example. And there's also a deep, I call it deep, or in the impact investing world, we see deep impact whenever there's also, you can see a willingness to, accept concessionary returns or take higher risks than would be usual. So these are extraordinary, investment decisions that are based or that are focused on improving the impact and additionality of the impact that you can generate. So additional emissions in this case, right? And so you can put this together into a little framework that I'm currently working on, where you can allocate and see how your portfolio aligns with these different strategies and with the different types of climate impact. And so to conclude, there are 2 quotes from Saul Griffiths that I like. So one is, if you're an investor, invest in companies that are working toward a carbon-free future. Be less greedy. Remember that profit means nothing if the planet is ruined. This is, I think, gives reason to think about. And if you're a billionaire, you might consider buying out fossil fuel lease or 2. Own a piece of history in some remote place. Turn it into a nature reserve. Divest, invest in startups, sponsor activist kids, lose some money swinging for the fences as though you were 24 years old again. You have nothing to lose other than the planet. And with this, I conclude, and I hope that I managed to be in time. I have much more prepared, but I deliberately had to shorten the presentation to remain within the time window. Thank you.
Thank you, Young-Jin. Fantastic presentation there. I don't see any questions other than where can the audience find the slides?
Yeah, happy to provide them afterwards. Which is the best way? So either you can send me a note and I'm going to send it to you, or I can supply, send them to Mohan and the SDI AI. Perhaps that's the best that I send them to you, Mohan, and you can distribute them.
Yeah, exactly. I'll put those slides online So they'll be on the SDIA's website. They'll also be on Sustainable Places website. So they'll be available immediately after this presentation.
Okay, good. Actually, there's a lot more content. So if there's some time left, I can also go through this quickly.
Yeah. Well,
not more, but just a bit more.
I'm
happy to answer questions.
I don't know about the audience. I can't see any other questions. So I'd be quite interested to spend another 5 minutes on that, on the impact investing side. So how you determine what's a deep impact investment and the sort of criteria you talk through when.
All right. Yeah. So I mean, one important concept, is additionality. So when impact investors distinguish between the additionality of the impact that their capital allocation creates, so meaning that basically they have provided capital to a project, asset, or company that otherwise, would not have been provided as easily. So in this case, mainstream markets, banks, commercial lenders wouldn't have provided the capital either, maybe at similar conditions or at all. So what you do is that you basically, to some extent, compared to the market rates that are usual for this kind of asset or project, you subsidize it to some extent, right? So you take a slightly higher risk than would normally be the case, or you accept slightly lower returns, or both, and you do this as a deliberate decision intentionally in order to ensure that emissions are reduced that otherwise would not have been reduced. So this is the greatest additionality that as a capital provider you can generate. And you have another level of additionality at the asset level, where if it's a company or project, infrastructure project, for example, it could, for example, create or generate or contribute to greater emissions reductions than would normally be the case. So if you benchmark it against the normal, the usual kind of, for example, renewable energy project, if you have extraordinarily high efficiency rates and you just make sure that you exceed the norm, then you create some additionality at this level too. So this is what I think would like to see as, or coin as a deep impact compared to broad impact, which is something that the mainstream markets have, are very eager to invest in. For example, green bonds are quickly oversubscribed. They usually meet all the requirements in terms of risk and return that are needed, and they contribute to the transition, right? So it's all good, but it's broad. There's not a shortage of capital here, and as we saw earlier, we do have a substantial funding gap, and one reason why that funding gap persists, is the shortage or lack of, for example, proper carbon pricing. The carbon pricing that is currently in place is still way too low, so it doesn't really improve the financial performance of projects that are much needed, right? Of energy projects that are not being funded because they just seem to be not profitable enough, right? Of course, a carbon price, a price on carbon, would be a game changer, and it would if it was in place, there would be so many more project developments happening, and so much more funding would go into these projects where the risk return ratio becomes substantially more attractive, right? So this is why here further back I say carbon pricing is a very important instrument, right? Here you see, just to give an idea of the current level to which carbon pricing is inadequate, the future economic damages from continued global warming are staggering, but the profitability of carbon intense products and services today is not much affected at all, right? Even though it's currently changing, so market forces are replacing or are pushing coal, for example, back away from the market, right? So there's has been lots of just unsuccessful coal projects or companies that went insolvent in this industry in particular. Although on the other hand, coal has continued to be subsidized, right? So it's kept alive artificially for some jobs or due to, you know, a strong coal lobby, even though it's today more economical to build new solar power plants or wind power plants, right? So it's a colossal waste of taxpayer money if you look at this. Yeah, so a carbon price would be a very important tool. And yeah, so one perhaps, if you allow me, Mohan, there's one aspect that I wanted to make sure to address too. One opportunity that I see, because we do have a very you know, low interest rate regime that we have entered since the you know, since the early 21st century. You know, you see here a long-term trend, but we have now negative interest rates for you know, some government bonds in Europe and so on, and actually interest rates are so low. You can say that there's a lot of, you know, there's never been a higher amount of cheap money around in the world, right? Looking for investment opportunities, having a hard time finding them, and the money supply has increased over the past 10 years exponentially. So the question is, how can you meet, you know, on the one hand, this huge supply of capital. On the other hand, as we saw, we have a huge demand for electrification and clean energy projects, and they don't fight each other, right? On the other hand, if the state would invest in, you know, the transition, it would really make huge public investments similar to World War II type mobilization. It would also create millions of jobs, you know. So this is the job forecast from the Rewiring America for a very ambitious scenario compared to the New Deal, right, where after a mobilization period, the transition to you know, clean energy is really enforced and pushed forward by you know, a very active state, and it's not even just, you know, state investments, but also public and private investments that would create millions of jobs, and they would level down at a stable level of 25 million additional jobs created, right? While of course some of the fossil fuel industry jobs would have to be replaced. That's the flip side. But you would, on a net effect, you would create more jobs than you would replace. So what governments could do, they could issue transition bonds that are very, you know, low interest, that offer low interest rates, but also relatively secure. So they give pension funds exactly what they need, you know, low risk, low return, stable over long periods, big, huge ticket sizes. You could raise, you know, hundreds of billions this way. And then you basically commission the great transition, the transition into the electrification of entire sectors, the modernization of the power grid. The government could commission this, you know, because in terms of infrastructure, the government is also one of the key agents to initiate such changes, and the private sector would have to implement this, right? Do what it does best. So this is the point that I wanted to make in this regard.
Very interesting. I don't see any other questions in the box, so I'll ask my own. You mentioned that one of the hardest bits is market adoption. You need the market to adopt it, to scale market adoption. And one way is, it, like you said, carbon pricing, because that builds in an externality that the market doesn't necessarily take into account. So is that it? Is that how it works? Is that what you think the best approach is? It's that sort of carbon pricing
so
mechanism?
I'm going back here a little bit. So this is where this chart comes into play, you know. So I mean, carbon pricing is a powerful enabler, you know. So I'm just jumping here a little bit back to this part, you know. But maybe it's not enough. So this is the hypothesis of Saul Griffiths. I don't entirely agree. I think carbon tax or carbon pricing anyway, you know, as long as there is a price on carbon, whether it's tax or emissions trading, you know, it's important that it has this transitional effect, right? So that's what matters in the end. But he's concerned that it might not be enough, and I tend to agree that we need a very ambitious carbon pricing. For example, there's a proposal in the US, you know, where the price is suggested to start at a relatively low level, but increase by $10 per ton every year, something like this. You know, this would be very, you know, ambitious, or could even increase. Perhaps it might even increase more. And the idea in the US proposal is also to use the income generated through this fee and distribute it as a dividend to households to make sure that households can cope with price increases they might see, and actually have an incentive to change their behavior as well to save money in the end, right? So they would get this free dividend and use it as they see fit, and so I like this idea in general of a fee and dividend too. But in addition to this, if you really want to speed up adoption, so this is what they suggest, you may need to have some kind of replacement mandate. So whenever a product reaches its end of life, and you are looking to buy a new one, you're mandated to, buy an electric one, right, or a sustainable one, a clean one. If your car is, breaking down and you want to buy a new car, you have to buy an electric car, right? So this is, of course, a heavy hand that the market, that the state would, promote. But it's not something that would be entirely unusual, or given the magnitude and urgency of the crisis. So you can compare it indeed with a situation where we have to mobilize for wartime. This is the kind of collective effort needed at this time right now, or at least for the next decades. For the next 2 decades, we would have to do this. Yeah. So that's the argument, to use a combination of market forces, carbon tax, technologies helping us, and then give them an additional push through different kinds of policies. It doesn't have to be replacement at end of life. Working to this end in order to speed up market adoption.
Right, and so that what you're talking about is there's no one single silver bullet. There's, from the regulatory side, from the sort of market side, there's all sorts of different approaches.
They all have to work together, yeah, in the end, right? Yeah.
And I wonder if you could just spend 30 seconds critiquing Europe's emission trading scheme, because I know.
Yeah. I mean, I think it has been now around for decades, and if you just look at the emissions reduction impact it had, it's very sobering, right, or disappointing, really disappointing. So the idea was good, perhaps in theory, and in practice it just didn't work. Of course, industry lobby groups made sure to protect their interests and avoid energy price increases that they saw. And so what happened in the end was that this emissions trading scheme just didn't work. It kept prices didn't increase. So in the end, again, whether you levy a tax, so there at least you have the certainty that you can control how the prices develop, or you try to limit supply, right, or in this case the volume of emission certificates, but either way, in the end, it's the price that matters, right, and the signal that it sends to the market, and the disincentives and the incentives that it creates. So if you're unable to control the volume, then you will end up with a price that is way too low.
I see.
Yeah.
Thank you, Young
hopefully
Jin.
It's changing in the future. Yeah.
Well, Young Jin, I know you've written a lot on this. I've read some of your articles as well. So I wonder if you just want to take 30 seconds to tell the audience where to go to read more on this, on what you've talked about, and other sources.
Oh, right. Oh, yeah. I really didn't put in my Medium website, but you can find me on LinkedIn. And of course, there's one last call to action that I wanted to conclude with. If I had a little more time, so I'm just jumping to this here, because I didn't cover the philanthropy side. But here, this is what you can do. So we talked about climate impact investing. There's a whole philanthropic side to this that you can also utilize, and what I think needs much more attention is pre-political giving. To support think tank activities, advocacy, lobbyism, and so on. But everyone can also become a net zero emissions organization or household and impact multiplier. A couple of organizations here that I can, for example, the Citizens Climate Lobby is promoting a carbon fee and dividend model. The Climate Reality Project is working on spreading urgency awareness. Fridays for Future, Extinction Rebellion, Climate Emergency Fund is one of the initiatives where they are similar to the Guerrilla Foundation. They are fundraising to support activism. which is very important too. Yeah, what I don't have here is now the link to my Medium page, but again, I think you can find me on LinkedIn easily. So happy to connect.
Perfect. Perfect. Thank you, Yoongjin. Thanks for that fantastic presentation. And I know you're obviously you're very keen on speaking to people, so I'm sure people will reach out over the next few days. So thank you for that presentation.
Thank you for the opportunity, and yeah, have a great day, everyone.
Excellent. So now I'd like to move to Alex. Alex is an associate at the Dutch Infrastructure Bank, and he works a lot on the infrastructure side of the work that the bank does, and in their move towards renewables. If Giuseppe, if you can make me the presenter, then I can present Alex's presentation. Alex's presentation is a pre-recording, but he'll be live for the Q&A.
Good afternoon. This is a pre-recorded presentation for Sustainable Places 2020. My name is Pierre-Alexandre Hughes-Daly, and I am an associate in the Infrastructure and Renewables team at NIBC Bank. NIBC is a small Dutch bank based out of The Hague. We cover Western Europe, so that is Benelux and Germany, the UK and Ireland, and the Nordics. Our activities typically revolve around corporate lending, originating from our own balance sheet, originating and managing debt portfolios for institutional investors. Good afternoon. This is a pre-recorded presentation for Sustainable Places 2020. My name is Pierre-Alexandre Hughes-Daly, and I am an associate in the Infrastructure and Renewables team at NIBC Bank. NIBC is a small Dutch bank based out of The Hague. We cover Western Europe, so that is Benelux and Germany, the UK and Ireland, and the Nordics. Our activities typically revolve around corporate lending, originating from our own balance sheet, originating and managing debt portfolios for institutional investors, providing advisory, M&A, and equity or debt capital market services. And I guess as the infrastructure team, we've been very much focused on digital infrastructure for the past 4 or 5 years. So we've built a bit of a track record on that front and have seen probably most transactions in the market from the debt side anyways. Today we're going to look at digital infrastructure from the point of view of a bank or debt financier. What is digital infrastructure to us? Why is it such an interesting segment? We'll then move on to a brief market commentary looking at the past 4 or 5 years of underlying trends shaping these segments, followed by what I hope is an interesting Financing 101 introduction to how banks look at a fiber asset, what the typical terms you would expect to see for such an asset are, and sort of how we analyze the asset itself and then the transaction to sort of determine the viability of the proposition. Finally, we'll wrap up with a look at what the big trends and the big topics we see coming up covering digital infrastructure, and how the segment's going to be shaped in the years to come. Communication infrastructure and data centers are at the heart of a world that is digitally transforming. As an asset class, infrastructure has changed a lot in the past 5 years. Typically, core infrastructure would have covered transport, regulated utilities, energy. Digital infrastructure didn't historically play a large part of this. This has obviously changed, and as the pandemic has highlighted, we as an economy, as a modern economy, very much rely on digital connectivity and the cloud infrastructure. So it's very much becoming, if not quite yet, a fourth utility, probably in a certain way one of the most core utilities that we have. Economies just don't function anymore without digital connectivity. In our view, digital infrastructure consists of 3 broad segments, each subdivided into their own subsectors, of course, but breaking it down, we look at fixed communication. By that, we very much mean fiber, pure fiber, so full-on end-to-end fiber connectivity from the backbone to the home or the building or the premise. Wireless communication, which can be broken down into mobile phone operating, network towers, in urban areas, but also the towers beaming broadband to hard-to-reach, underserved rural areas. And data centers, historically more of a real estate play, but now very much seen as part of the digital infrastructure sort of ecosystem, if you will. Why do we see it as such an interesting segment? Typically, these assets benefit from stable, predictable cash flows. In the case of data centers, before the data center is even built, typically you'll have a 5 to 7 year contracted agreement for the provision of storage and processing services. In the case of fiber or wireless communications, there's a high stickiness to the revenues once the network is built and operational. If you think about it, how often do you change your internet or wireless service provider? It's a strong growth segment, and this is important, and we'll come back to this later on. Growth very much underpins the entire investment philosophy of the sector at the moment. In the case of fiber and wireless, we are still not at a point where these networks are really generating positive EBITDA, positive revenues, as we're still very much in the capex, so that is expenditure of capital to build the network phase. And in the case of data centers, the entire segment is underpinned by growing data consumption trend, growing cloud infrastructure, and need for further processing power in the years to come. So very much not even at the beginning, but just in the middle of the growth phase of the asset. It's a strategic niche market. Our economies are so dependent on the cloud infrastructure and the connectivity infrastructure today. It's hard to sort of think how our economies would function if we just cut off the internet or the data server access in the modern economy. And I think this has been very much highlighted by COVID and the shift to flexible working and working from home in recent times. We also see this sort of shift to the strategic view of the sector just from the words of government. The British government is very supportive towards the digital infrastructure, European Commission as well, German government full backing, and this is set to continue as people realize that actually they need a solidly built, highly redundant digital network. And finally, it's a quite resilient sector. Again, COVID sort of highlights this, but more generally, once these assets are built, they will generate utility and revenue and services for many years to come. Once a fiber is in the ground, it's the dominant technology and likely to remain the dominant technology for years to come. Same with a data center. Once it's been built, you have that data storage capacity. So quite resilient assets. Looking at data center activity, as mentioned, very much underpinned by a growing data consumption and data storage requirement trend. If we look from 2016 through to 2021, we're talking about a quintupling of data storage volumes. This more rapidly, as we sort of progress forward, is being also driven by big data. Big data has been a big trend for many years, but I think we're only just sort of starting to build that steam where people know what to do with big data, and thus storage capacities are very much being driven by that. Increased storage capacity requirement means increased data centers, more data centers need to be built. So that has driven data center M&A activity. If we look at H1, H2 2015 on the graph on the right, we see 25 transactions compared to 60 transactions in the second half of 2019. And that set is very much set to continue. In the latest numbers I've seen is that in 2019, 10% of all infrastructure spending, so that's the asset class as a whole, was on telecoms. Through the first half of 2020, that has gone up to 25/30%. So a substantial shift, and we expect that to continue. If we look at this slide, this one's quite an interesting one as it sort of highlights the journey, if you will, of infrastructure going forward. If we look at October 14, and the dark blue line, we'll see that the valuations, the multiples were about 12 times. What does that mean? Well, it means that for every euro of EBITDA that your data center was generating, people were willing to pay 12 euros to acquire it. So at that time, those multiples had evolved over time. And if we look in October 2019, and the acquisition is a pretty big transaction from Equinix and Digital Realty, those multiples are in the 20s now. And this graph ends October 19, but based on what we've seen throughout 2020, those multiples are now at sort of 25, 26 times. That's quite high. That's a lot of money being spent on your assets. This has been driven by the huge amount of liquidity that's being poured into the sector as investors look for, one, positive returns, and two, stable, safe assets, especially think of the institutional investors which need to put their money somewhere. So you do start to wonder if at 26 times you're really getting value for your asset. Again, you get 4 or 5 bidders per asset every time a transaction takes place. I think there is still value there. I wouldn't panic yet. If we look at the light blue line, we see that the leverage ratio around just under 3 times in October 14 has steadily, but not overly quickly, creeped up to just about 4 times leverage as of 2019. I think within the scope of infrastructure assets in general, a 4 times leverage is nothing to panic at. That's roughly as expected. So quite a healthy market, a lot of activity, a lot of liquidity, and quite a lot of deals being done, which is a good sign, especially in light of COVID. I think the sector has kept on booming. So 2020 being a busy year, 2021 will probably be even busier. If we look at fixed line communication, or I will say fiber, going forward, fiber is considered to be the superior technology at the moment, especially given sort of the large bandwidth you can pass through it. But if you look at the graph on the left there, we see there's quite a disparity still in Europe in terms of coverage. So what the graph shows you is, as a proportion of the number of households within a country, how many can be served by fiber. So that's not connected, but hypothetically, how many could connect to a fiber network if they so chose to. And we see that countries such as Spain and Portugal are very much leading in that direction, with rates of 80% and above. However, if we look over to the right of the graph, we see that Germany, so that's DE, and the UK and Belgium, BE, still quite far behind. As of the end 2019, I believe, UK is only just at about 10% coverage. I think we expect by the end of 2020 it'll be around 20% coverage. So there's still a large segment of the market that needs to be built. I think that leads us to see the UK and Germany especially as quite healthy markets in the years to come on the fiber side. If we look at the graph in the top right, we see, for example, in the UK, 2.8 million homes passed in 2018. That's expected to go up to 27 million by 2025. That's quite a fast growth. And that's a lot of capex. That's all going to need to be financed. So great opportunity for the banks, a lot of financing coming our way, and probably a lot of M&A activity to follow on the back of that. 2020 has been the year of fiber so far. If we look at the bottom, we see quite a few transactions have taken place this year, and also quite a variety. Not all fiber assets are the same. It's not a cookie cutter industry. If we look at Deutsche Glasfaser or Nexio, big German networks, we can see BNT, so SOCO BNT, which would be a smaller rural network in Germany. Glide, a UK asset which services mostly student accommodation and hard to serve business parks. Different niche to GigaClear, which again focuses on targeted government subsidized UK rural regions. So quite a few transactions in the fiber space this year. As we speak, we're still closing a couple more, so we expect to see a bit more activity before year end. And I think that's just setting us up for an even more active year next year in the segment. Wireless communication is an interesting one. Probably the biggest point to make on wireless communication and the advent of 5G is that 5G doesn't compete with fiber. Rather, we see them as complementary technologies in the years to come. So again, plenty of market share for everyone. from our perspective, and I guess when I talk about wireless communication, I'm not really talking about the big, huge tower networks you see across, across countries, serving sort of Verizon-style mobile networks. That's not necessarily the segment we as a bank play in, but we tend to look at the smaller, and if we look at point number one there, the smaller regional operators. So we've seen quite a few names pop up recently, such as Imagine, which is an Irish rural fiber provider. So that's a tower built that then beams broadband to villages and nearby properties. So enhanced mobile broadband, I think, is where it's at right now. And as I said, we're still seeing a few names in the market slowly crop up. So Airband, the Air Fiber, a couple of others, currently raising equity, I believe, and sort of seeing how that develops over time. As this segment matures, we will then move on to point 2 and point 3. So point 2 is very much as our cities become smarter, as we start developing a bigger sort of Internet of Things ecosystem, we will see that there's a much larger requirement for sort of data connectivity and data touch points. Every time you touch an app or every time you interact with a digital appliance, that signal needs to go to a data center, get processed, come back. And I think as of 2018, we per capita we interact about 1,500 times a day. That's likely to increase to an expected about 5,000 times a day by 2025. So as these ecosystems sort of settle in, we will see more wireless transactions, I think, going forward to build up that tower infrastructure. So looking, I guess, at the case study, and this is very much a fiber financing 101, probably the most important part, and this comes back to that growth point I made earlier in the presentation. CapEx is spent upfront in the case of a fiber asset, but the revenues are not generated until 3, 4, 5 years down the line. And so that disconnect between the spending and then the ability to be paid back down the line is something that we as banks need to get comfortable with and sort of understand before we finance the asset. And I think you'll see a variety of specialist financiers and the usual lenders who've been in the segment for several years now, who've gotten their heads around this interaction. What this graph shows is the penetration rate on the left and the penetration rate growing over time on the bottom. So what do we mean by this? Well, as you build your network on day one, not everyone who within reach of your network will connect on day one. You might have a small portion on day one, 3, 4, 5%, and we call that the penetration. Over time, as your network is embedded and as more people connect, your penetration rate will increase. So we see that if we look at the light blue line, cohort 1, we see that over the course of 4 or 5 years, or in this case quarters, which is how banks typically look at these things, by the time we're quarter 16, quarter 20, so that's year 4 or 5, that cohort will have grown from 0 or 5% penetration steadily to what we see as being the cruising penetration, if you will, of 35 to 40%. And that 35 to 40% is really when that network is generating positive revenues, i.e., it's now at a point where, bottom line, it can afford to pay back the debt it's incurred to pay for the initial rollout of the network. So in cohort 1, quarter 1, you draw the debt, you build your network, you're then negative revenue over the next quarters, progressively less and less and less, until you break even, and then by the time you're sort of quarter 16 to quarter 20, so year 4 or 5, your network has reached a critical mass of subscribers where that positive revenue is being generated, and thus you have the ability to pay back your debt. But during those first 4 or 5 years, obviously, you're not paying back that debt, and I think banks spend a lot of time being comfortable about that. Another point to note is, and this makes sense when you think about it, typically operators roll out their networks in incremental stages. Cohort 1, the first network that the operator builds, will typically be quite small, 10, 20, 30,000 homes. Cohort 2, once the operator is a bit more experienced, so that's the next year's building. Cohort 1 could be 2015, cohort 2 could be 2016's growth. And that cohort will be a bit bigger. And then cohort 3 will be even bigger than that. I see it's in red, it says cohort 2. That should be cohort 3, my apologies. So that incremental increase in your network size also means that actually the majority of your revenues will be generated by a cohort 3 that is the right size down the line. And by that point, if we start at quarter number 9, by the time we get to cohort 3's cruising speed, well, it's actually probably 6 or 7 years in. So that impacts the dynamic of the financing as well. This brings us on to the fiber financing itself. What does the fiber financing look like, and how do banks get comfortable with the underlying asset? So on the left, we've got typical terms. We see a tenor of 3 to 7 years. That's the duration of the loan. We introduced the concept of availability period. This is the period during which you are drawing down on the loan and spending that money to build your network. And then the post-availability period is that, as described on the previous slide, it's that period of time after your network's been built where it's starting to generate the revenues it needs to in order to be able to pay back the loan. So we always look at these financings with that availability period concept. Availability period typically of between 3 and 5 years, with the final 1 or 2 years of the facility being the post-availability period. Because you're not generating revenues during the availability period, or rather you're not generating enough to pay back your debt, as lenders, we have what we call drawdown tests, which is a way for the lenders to be able to ensure that your rollout of your network is going according to plan, fundamentally. So we look at typical tests such as debt to network size or debt to home passed. This is the total debt drawn at test time divided by the number of homes your network can notionally reach. And that gives us a pound or euro or dollar number, which is essentially how much is the additional home costing to be encompassed by your network. And we can compare that to your original forecasts or the original discussions we had when the financing was put in place, or even sector comparables to see, well, relative to what we would expect, are you deploying your capital in a reasonable and efficient way? Your debt to subscriber base, or debt to home connected, is a more granular concept, and that looks at your debt divided by the actual connected homes in your network. So it's all good building a network, but if you're building a network to empty warehouses, you're never really going to get the revenues needed to eventually pay back that loan in the first place. So that's a more granular insight as to how profitable is your network, how many people are actually connected to it. And the third one, the penetration rate or minimum penetration rate, is the same concept, but over time, as we discussed, our expectation as lenders to someone building a network is that in the initial year, you'll have a relatively low penetration rate, 0 or 5% or whichever. But over time, we would expect that penetration rate to increase. So year on year, those tests increase just to ensure that everything's going according to plan, the penetrations are going up, you're connecting homes, and you're building a solid, successful network. Following the end of the availability period, we will have a more traditional financing covenant. So here we look at things like debt service ratio or interest cover ratio, and that's the revenues, or the EBITDA in this case, that you're generating divided by the interest or the amortization, or both added together, depends on the ratio. And it basically covers your ability to pay back your debt. And that's a much more traditional banking financial covenant you will find in your documentation. You'll also find a leverage ratio covenant, typically in that post-availability period. This covers just the amount of debt you have to the amount of revenues you're generating. And obviously in day one, year one, we would expect that leverage ratio to be very, very high because you're not generating the EBITDA, the revenues you need. But over time, we would again expect that leverage ratio to decrease. And this is another way for us to monitor just how well the asset is going along. So these are covenants which, as lenders, we're not putting those in to limit or control your ability to stick to your business plan. And typically they will be sculpted or set at levels pre-agreed with yourself to give you a margin of error and an operating width to run your business. But they are important for the lenders to be able to understand, well, is the business performing according to plan? Other concepts you'll find are equity support. So this is, as a lender, we just want to ensure that the initial borrower has some skin in the game as well. Now, what this clause typically says is that for every pound you spend on deploying your network, we as a lender will pay, I don't know, 60, 70, 80% of that. The rest will be paid by what we call the equity sponsor, the owner. And that's just a way, again, for lenders to ensure that they aren't taking all the risk, but are sharing the risk with the actual business owner or operator themselves. Distribution limitations, these are clauses which come in to fundamentally limit cash exiting the business towards the shareholder. If, as a lender, we are financing a business, we want that money to be spent on building the network. We don't want that money to be distributed to the shareholders. So typically you'll find no distribution clauses during that availability period we discussed. And then as the business starts to generate the returns and the positive revenues, then those limitations are relaxed and become more borrower friendly as well. And finally, but not least, you'll look at information undertakings. And this is important because, again, during that availability period where you're in a network building stage, because there are no financial covenants and there's no way for us as lenders to really, truly step in if things aren't going well, typically we will have information undertakings which require the business, the borrower, to, on a quarterly or semi-annual basis, share their management accounts with us, share their financial statements with us, and also give us updated budgets, amongst other things. But again, just share information for the lender to be comfortable that everything's going according to plan. And typically, when negotiating these financing documents, these will be the main topics, so availability period, drawdown tests, financial covenants, distribution limitations, information undertakings. These will all be the topics on which there's a bit of to and fro in negotiation to ensure that the banks are comfortable with the financing, but also, and this is important to remind, is that we are there to provide a lending service. So ensure that the borrower has access to the capital they need and the operational margin they need to run their business successfully. On the right, we'll look at sensitivities and credit analysis. That's how do banks look at these assets? How do we actually determine whether this is going to work or not, from our side anyways? So we look at your strategy or your unique selling point, your USP. What is your business built on? Is it in the case of, for example, like GigaClear, are you building a network in a rural area underpinned by government subsidies? Or are you more of a glide? Are you building a network which targets a specific niche that's underserved by other operators and competitors? What's the moat on which your business is being built? We look at the management team track record. Is this a business which is being run by people who've built these networks before, have got the track record, the experience, and many years in working in telecoms? Or is this a new entrepreneurial project? Different banks have different risk appetites, and different banks lend at different stages of the fiber growth curve. So it's quite important for the lender to understand just how much experience that management team has. And finally, we look at things like your competitor field and your overbuild risk. That's very much geography dependent. If we look at the UK, where only, as I mentioned, 10% of homes are covered, there's plenty of market share for plenty of operators to develop without competitors seeking to build on top of each other. But in other segments, in other geographies, that will be a consideration. What's protecting your business from competition on your network? So these are more qualitative topics we look at. On the quantitative side, we look at the revenue makeup, and that's quite granular, and these will be the things that we actually sensitize in the financial model. What is your pricing structure? How competitive are you? Are you at the top end of the pricing, at the bottom end of the pricing? Who are you going to generate your revenue from? Are you generating your revenue from sort of long-term 12, 18-month contracts? So, as an example, if we look at Virgin Media in the UK, if typically when you sign up to them, you sign up for a 12 or an 18-month contract, that's stable cash flows for a certain period of time. Or are you generating your revenues from monthly direct debits, which can be stopped at any time? What is the quality of your underlying customer? Are your revenues as your customer base sort of high net worth individuals in urban areas, or are you generating your revenues from students, which sort of come and go? Typically, we'll sensitize all of these revenue metrics in the model. And what we'll do is we'll say, right, well, if your average revenue per user, so the amount of revenue you expect to make per person within your business is X, well, let's cut that by 20%. Does the proposition still work? Is it still viable? And we're not doing this because we're trying to sink the financial model, but we're just trying to understand. And, again, as COVID has shown, well, things happen. And what impact those things have on your business? How resilient is your business to change or to adverse impacts? Construction capacity and resilience is probably one of the most important ones we look at. What is your capacity to roll out your network and to meet those targets? Typically operators will rely on third-party contractors to build their network for them. How reliable are those construction crews? Are they trained? Can they roll out the 5 or 10,000 homes per month that in your business model you forecast? And if not, how resilient is your business to a delay in construction? Again, coming back to COVID as an example, many construction crews self-isolate because one member is ill, so the entire crew goes down for a 2-week period. Well, what impact does that have on your rollout plans and thus your future revenues being generated? How resilient is your business to this? And then finally, your cost basis. And this comes back to maybe your strategy point. Are you building the network end to end, including the backhaul up front, in which case that's quite an expensive network to build up front. But over time, once the network is built, well, the maintenance costs are quite low. Or are you leasing the backhaul? Are you leasing the national backbone of your network and only building perhaps the last mile of the network? In which case, well, that's quite cheap to do. You're only paying to build the last mile, but it means that over time, you have recurring lease payments year in, year out, and over time that's expensive. So how are your costs structured? And again, we will sensitize that by either increasing them by, say, 10, 20% in the financial model, just to see what the impact of your cost basis has on the profitability on your business. So just to give you an idea, the kind of things that we as banks look at and how we sensitize them. And again, I would like to reiterate the point. We do this just to be able to more thoroughly understand how the business functions and its resilience to change or adverse effect. But at the end of the day, we seek to provide you with the capital you need for your business to grow. So conversation, sharing of information is always good up front. Just that way everyone knows how the transaction proceeds and what the expectations are in the years to come. To wrap up the presentation, I guess we'll look at the future of the digital infrastructure market. What are the themes that we see coming up? Well, firstly, and again, to bang on the drum, that's growth. We do expect the field to continue to grow. But what I mean by this as well is, as it continues to grow, those revenues start to get generated and you sort of reach more of a stable state. And that'll be the point where we think the segment becomes more of a utility as opposed to that growth stage it's at. And when an asset's at a utility stage, that will have its own implications on pricing. It'll have its own implications on the type of lenders and the type of investors that you see in the field. Consolidation within the data center space, well, I guess we're already seeing that. We're seeing sort of the big mega players. We're seeing what Silicon Valley come across. We're also seeing the Equinixes, the Digital Realties of this world acquiring left, right, and center. So I think in the data center space, we're already seeing that consolidation trend pick up. And that's obviously going to continue. In the fiber space, there's still enough time and growth space, so to speak, for individual operators and entrepreneurs to build their networks. So I think we'll see consolidation, but probably a couple, 2-3 years away from the main spurt on that side of things. Long-term investors, this comes back to the liquidity flooding into the market. As the sector matures, we will start seeing the players change, and we'll move away from venture capitalists and private equity more towards more institutional investors with a longer term view. So the pension funds and the insurance funds and so on and so forth. And then finally, but again, very importantly, regulation. As this segment becomes a utility, it will start to be regulated like a utility. Ensure there's competitive practices, ensure there's no price gouging for the consumer, and probably most topically, how is data being processed? Is data protection, being adequately addressed? And I guess we're seeing sort of the conflict, well, not conflict yet, but the differences in views between, for example, the European Commission, the European Union, and Silicon Valley. How is that going to play out, and how is that going to impact the segment going forward? Finalizing, a brief disclaimer. Please don't go and make investments in the segment without doing your own research and understanding the segment itself. This presentation sought to be informative and educational. I'm very happy to discuss it further, but that's up to you. And finally, my contact details. If you have any questions or further discussions you wish to have on either opportunities or just the segment in general, please do reach out. Thank you for having me.
Show your screen, okay. Thank you, Alex. I wonder if, Giuseppe, if you can make Alex a presenter, and then we can start our Q&A. And we do have a few questions, which is fantastic. Let me just get off this screen, this view. Alex, you're live now.
Can you hear me?
Yeah, Alex, but there's a bit of an echo in the system, so I wonder if there's a.
There you go. Should be better now.
Perfect. Thanks for that presentation. I thought it was very interesting. I wonder if we start with a question from Emma Fryer regarding data center M&A. Do you think there is a risk that the industry will become increasingly oligarchic? And do you think there will constantly be new players entering the scene?
I think the truth probably lies somewhere in the middle, and that you'll probably see cycles of dominance as the sector initially consolidates. We typically see the same recurring 3, 4, 5 mega players sort of involved in all transactions. And even in those where there are multiple bidders, you tend to see the same list of 4 or 5 bidders post-transaction and the same winners, so to speak. So I think there'll definitely be a period where there'll be consolidation to the same 4 or 5 players. However, over time, we would expect there to be enough space for a whole slew of new operators to come in and participate. And as mentioned, perhaps in my closing words, as regulation sets in, once this establishes itself further, we'd expect to see a more diversified market.
And just so on that regulation front, how could regulation impact data flows? I know the World Economic Forum is quite worried about this sort of data privacy, but also data sovereignty laws, and the sort of regionalization of what was previously a global internet. How does that affect data flows, and how would that then affect fiber?
Sure. So I think fiber in itself will keep on growing independently of what impacts perhaps data centers. Fiber being the sort of the better technology and the faster speeds, just from a consumer perspective, there will be demand for it, irrespective of perhaps the regulatory environment at a higher level, shall we say. When it comes to data centers, what you might start to see is either a regionalization of the owners and the operators of the data centers, depending as to whether the new regulations or the new geographies fit in with the mandates of the investors and the funds, or you might see a switch to location as new geographical areas with perhaps more friendly regulatory frameworks open up, and better incentives to develop their own data center clusters. Although it's worth noting that the current clusters of data centers and the local governments are heavily incentivized not to rock the boat too much. And I think we'll see a notional fight on the regulatory front, but the financial incentives and sort of the contributions to the economy are so high, it probably wouldn't see too much of a final impact in our view.
Okay, I see. I wonder if you can give, this is a question from Reza, can you give some context and insights into potential regulations that would be adopted in the industry?
Sure. So I guess how data protection is handled would be the obvious one. If we draw a parallel between how banks perhaps have been regulated over the past decade and the implementation of new regulation on data center operators, that will obviously add a bureaucratic and legal cost to sort of the day-to-day operations. That will eventually translate into either the more successful and larger sort of data center operators being able to bear that cost and thrive, and perhaps even throttle those new operator entrants mentioned previously, or that cost will be passed on to consumers. I guess from a data center perspective, it's difficult to think of the consumer as being you or I, but there will eventually be a trickle-down impact. When it comes to fiber, what we'll see with regulation, we expect is just a capping of pricing structures. We see quite a wide pricing spectrum right now for fiber services, as it's very much still the Wild West phase of the development of the networks. And you still have highly monopolistic operators in their own regions. Over time, as the network becomes more integrated on a national scale, governments will step in and put on price caps or customer service guarantees. Like requirements, which I suspect will be what we see happening probably in the next 2 or 3 years.
I see. And back to that first point, reinforces what you said earlier about potentially consolidation and oligopolistic tendencies in some of the players, certainly in the data center realm. So that let me see if I can sort of regurgitate your argument. That is indicative of an industry that's moving towards utilities and utility investments, utility regulations. Is that right?
Correct, and I think that is the end game. That's the end state. Fiber connectivity specifically will definitely be the fourth utility and regulated as such. And when we get to that stage, the makeup of, at least from the financing perspective, and the players you see will follow much more the model you would expect to see if you were looking at a water utility or a gas network and so on and so forth. However, right now, because we are still very much in a stage of growth, where you have to put up the capital up front and you're not seeing the revenues for 4 or 5 years, we're not quite at what we as financiers, I guess, would term as a utility stage. I appreciate it's probably a subjective term, but I guess when I refer to utility, I very much mean the financing structures you typically see for assets that fall within that description.
And then a question here from Ryan. In regards to COVID, do you expect any impact to continue next year if the pandemic extends?
I think the segment as a whole has been incredibly resilient, and and I guess I used the word lightly, but probably one of the winning segments under COVID. That's not to say it hasn't taken a slight knock. Obviously, as mentioned, ultimately these assets need to be built. So I think we'll continue to see minor delays to roll out plans. Just as construction crew temporarily go offline or have to sort of wait out a certain period before they can continue to build their assets. But within the context of the scale of the growth and the scale of the market needs to be addressed, compared to perhaps 5 years ago, the sheer number of contractors and building experts which have the requisite knowledge and training to install and build these assets has obviously amplified substantially. So those delays are very much minor delays as opposed to perhaps the critical impacts we see in other sectors of the economy.
Okay, and now a question from Reza. Do you expect potential regulations to imply certain minimum standardization? So I guess this question is based on standardization. Would standardization come via regulation, or do you think that's something that the industry would find for itself?
Let me have a little ponder on that one. I think that standardization will occur just from competitive practices in the first place. I guess the easy example would be to consider Virgin Media and the different sort of speed packages they offer from a fiber perspective. I think they call it all, super fast fiber broadband, super fast fiber, super fast broadband. You have a whole variety of different marketing terminologies, which aren't necessarily very clear. Over time, however, the consumers will become savvy to these definitions, and so I'd expect there to be a standardized product. And much in the same way that today, I think when we talk about broadband, we talk about fiber, we're talking about less than 60 meg, above 300 meg a second speeds. The government will eventually then step in and set in definitions or standards of service, in my view.
Okay, brilliant. And then we have time for just a few more questions. I have some questions here from Emma Fry from Tech UK. Tech UK are trying to encourage their operators to adopt power purchase agreements that essentially fund additional utility scale renewable generation. This tends to be limited to the larger players with appetite for risk, expertise, and deep pockets. Smaller operators need help mitigating longer term risks. Can these risks be accommodated in financing, and how is that done, as presumably the asset classes are getting mixed up here?
For sure. I think more and more we're seeing, obviously we talk about data centers that they're just one type of asset. Within data centers, you've got a whole different grouping and different types of data centers. In the newer generation, the newer build projects we see typically come with PPAs, power purchase agreements assigned, or with plans for on-site generation or near generation assets to be built at the same time as the data centers themselves. We're also starting to see data centers where they build batteries on site or even solar panels on the roofing. So it's a bit of a roundabout way to answer your question, but the energy side of the data center itself is increasingly becoming part of the conversation, and there are solutions at every level. It's not just the big operators which look at this topic. We in fact are currently looking at a very small data center where they're installing a quite a cost-effective on-site battery storage facility. The capex requirements of which are not high, so it's very much within reach of new entrants and entrepreneurial operators as well as the established players. And financiers are aware of this and obviously factor this into their analysis.
Excellent, and that leads me into the last question of the session. You mentioned that this asset class is attracting new types of investor. Is that true of both fiber and data centers? And could you expand on that a little?
Certainly. So I think I'll start with fiber. And if you haven't picked up on this, fiber is perhaps my personal area of specialism. Over time, as fiber has grown as an asset class, I guess initially, say 2015, the investors you would have seen in the fiber space will have been the venture capitalists, the PE funds, and sort of those type, perhaps more short-minded, quick, not quick buck, but sort of turn over the asset in 5 years and then resell it type mentalities. As we approach those sort of more established built networks of a longer term cash flow, established cash flow views, you start to see a different sort of player into the market. And I think here we're talking about institutional investors, we're talking about the pension funds, the insurance funds coming in both as owners, but also as sort of long-term lenders directly in the asset class, because that sort of long-term vision of the cash flows matches with their own liabilities. Within the data center space, I think the data center space is probably a bit more advanced in that field than the fiber space. However, because data centers have such a wider geographical remit and different sensor scales, if you're talking about hyperscales, it's a different conversation to colo data centers. So it's more of a mix, and I think depending on the asset, you'll see some VC players, you'll see some PE players, but we also start to see those long-term pension fund, insurance fund type, infra fund type players in the space as well.
Thank you. Very interesting. I think that I'll bring the session to an end there. Thank you, Alex, for joining us. Alex is an associate at NIBC. He's given us quite a nice deep dive into the thought process of infrastructure investors and what they think through. And he went through a case study with fiber. And then earlier, of course, we had Young Jin, who's an impact investor at Fineo, talking through the sort of criteria that they look at and why and how. He mentioned deep versus broad investing and so on. So that brings to a close our finance session on the first day of this conference. I hope you've enjoyed it. Please feel free on your screen as attendees. You should see some handouts. So Alex is available. He's put his contact details there. He's also put his slides there if you want to download those before you go. And I want to thank you, attendees, for joining us. Thank you, Alex and Young Jin, for your time. It's very, very interesting conversations. And I hope to see you all tomorrow morning for the Technology Progresses section of the conference. This is where we talk about new technologies influencing, in particular, the digital infrastructure space. So thank you all for coming. Thank you, Alex. Thank you, Young Jin. And I hope to see you all tomorrow.
Thanks for having us.
Bye. Thank you.